Welcome to M&A Access, the official podcast for the Alliance of M&A Advisors. Today we have Robert Ruff with us. He's from Telos Capital Advisors, and I'm very excited for this conversation. We've had such good chats over the years. I've learned so much from him. He serves on the AMA Advisory Council. He's active in the Dallas chapter as well. Just a man who has so much insights to share and knowledge across the M&A field. So we're excited to have you here today. Thanks for being here.
Great to be here, Gina. Thanks for having me.
You're very welcome. Very welcome. So tell us a little bit about your journey. You've been almost in every single major seat there is to sit in the M&A space. So tell us about that.
Yeah, very interesting. I've been dealing with capital markets basically my entire career. Started off as a commercial banker where we funded what later became known as a leveraged buyout. Went to Deloitte, worked in mergers and acquisitions for a couple of different companies there. Then I went into industry and was a CFO for several companies, president several companies. Also, we did an acquisition and a refinance in every single company I was in.
Wow.
Had a private equity fund, and we did 15 transactions in the fund, did several independent sponsor deals. So about 10, 15 years ago, decided to take all this knowledge and experience, and partner and I got together and formed Telos Capital Advisors. And as you know, Telos is a Greek word, and it means outcome and what you're meant to become and whatnot. So we wanted to use our experience and our skill sets in the lower middle market to help entrepreneurs achieve their telos.
Mm-hmm. I love it. I know we were talking about it earlier, but that is absolutely my favorite Greek word. So when I saw that was your company way back in the day when we first met, I thought, I'm going to like this dude. So what has been your favorite part in sitting all of those seats throughout your career? What have you loved most about it?
Well, I mean, I love what I do now. And again, it comes from helping these people achieve their goals. And we do sell-side work, but we predominantly do capital raises. Part of that is because very few people in the lower middle market will do capital raises. Everyone wants to do sell-side. But we have the skill set and the experience to do capital raises. They're very difficult, or they can be very difficult. It's kind of like putting a puzzle together. You've got this company, maybe they're doing an acquisition, maybe they need to do refinancing, restructuring of their balance sheet, maybe they just need growth capital. And we've got to figure out, based on what the company's needs are today and in the future, we've got to figure out what that puzzle of a cap stack looks like.
Right, not just right now, but for long-term growth.
Exactly.
Right.
Yeah.
I remember, I think it was San Diego over Martinis. I said, Robert, tell me about a cap stack. What is this? And you did such a good job of explaining the differences between, the different kinds of capital, why you would use this, why would you use that, how do you mirror. And I can see what you're saying about it being a puzzle that's unique to each, purpose and goal, right?
Absolutely.
So what do you do when you first sit down with a client? How do you prepare them for a capital raise in the first place? Because that's something that needs to be done, right?
Sure. First, we try to understand what their goals are. Let's say they're doing an acquisition. Well, are they going to do more acquisitions after that, for example? And with that knowledge, we build a model and project out 4, 5, 6 years, because it's very important to understand, the debt folks, the debt providers, they want to obviously make sure they're going to get paid back and that the company will be able to service their debt along the way. Equity providers look at it from a totally different lens. They want to make money. They want a return on their investment. So they're looking at growth, and they're looking at the returns that they can get for their equity. So you've got two very different viewpoints that you have to satisfy when you're building a cap stack.
Right. And so when you're looking at what their goals are, and if they're looking to acquire, if they're looking to, do you ever do other things other than acquisition with the capital?
Oh, absolutely.
Yeah. What else? What's your array?
Sure. Capital raises can be used for growth. Just so we're talking to a company right now that wants to raise $50 million to geographically expand their business. And they have to build facilities and all those sorts of things. So that would be another use. We have worked with companies that just had to refinance. They had a very bad cap stack. And it was no longer appropriate for where their business was and how they were going to run it in the future. So we had to reorganize their cap stack. And then I guess another use could be to buy out shareholders. We're talking with a company where there's two brothers who each own 50% and have decided they don't like each other anymore.
That's
so
sad.
We're talking with one brother about buying out the other brother. So those are just certain ways. Or it could be just a single owner who wants to take some chips off the table, de-risk their investment. And so we can raise capital to, maybe buy 30% of the company or take out some percentage like that and get them some liquidity.
Interesting. What do you find is the trickiest bit of it all?
Going out to the market, because sometimes we may come up with a cap stack that we think is appropriate. And we go out to the market and we get offers back that change the game, different than what we expected. And so then we have to reposition and negotiate with those folks. And also you have to work with the different capital providers. Sometimes you have intercreditor agreements between two types of debt. You've got the equity agreements between the existing capital and the new capital. Sometimes you've got a mezzanine player who has debt plus an equity component. So it's getting all those parties to agree and putting down a marker. Okay, we're going to put in $10 million. And then you go back and you have to say, well, things changed and now we need 12. Things like that. So it really is putting together a jigsaw puzzle. And sometimes the puzzle pieces keep changing shape while you're doing it.
They're moving.
They're moving around.
They are. So you are a really great educator. He was my SEMA instructor, and for a couple of the classes, how much I would think there's a fair amount of education you have to do for your clients about what are the different types and what are they getting into and really how are they going to achieve that goal to make sure that they can service the debt, right?
That's absolutely true. We spend a lot of time up front talking about what is their appetite for debt, what is their appetite for giving up equity. Exactly. And it's actually become more complicated in the past, say, 10 to 15 years because the private credit market has just grown dramatically. It's exploded with non-bank lenders and other forms of debt and equity capital. There's almost an infinite variety of capital out there right now. Mm-hmm. So we worked with a gentleman who was buying a company, and we found 30-year cash flow based debt for him. Actually, it's debt equity, dequity, I call it. But, and it worked perfectly in his situation. But, who'd have thought you could find 30-year money?
That's wild.
Out there. So you we spend a lot of time getting to know the markets and understanding what's available in terms of capital.
That's something I'm curious about. What are you seeing right now? Because I know that we're seeing a little bit of consumer capital kind of tightening the belts and battening down the hatches with what's going on in the economy. What are you seeing in your markets?
Commercial banks are, I would say, fairly conservative. They definitely like asset-based loans over cash flow loans.
Right.
So cash flow loans from senior banks are more difficult to obtain. You just can't get as much leverage on a cash flow loan. As I alluded to, the private credit market, there's, I think, $1.7 trillion of private credit been raised in the past X number of years. And so there's a lot of private credit available.
Interesting. And they need to be out there, right? They need to be.
They need to deploy that capital,
right?
Yes.
Yeah.
So there definitely is capital available.
Okay.
But the deal has to make sense.
Right, for everybody.
Right.
For all the partners and all the pieces.
And that's kind of where we come in, right? We're building the model, trying to be conservative, but explaining to everyone, here's how it's going to work, and here's why this cap stack makes sense.
You're kind of a little bit like engineers, it feels like.
Yeah. Fair enough.
That is kind of fun. So how many of these do you usually do a year?
We only do 3 to 5 deals a year.
Oh, wow.
There's only 3 of us. We're all senior guys. We don't have any junior staff. We get extremely involved, as you can imagine, to put together this model and make it believable. We have to get very deep into our clients' financial situation, their operational situation. If they have growth plans, we vet those. We kind of go in and do diligence almost with our private equity buyers' hats on. And so by the time we come to market, we know our clients extremely well.
Are there any times that you say, sorry, but I don't think this is a good idea?
Oh, yeah. We turn down a lot of work. It's normally because it's too speculative, it's too venture in form, and we're just not, we don't have those connections. Our investor universe is institutional investors, SBICs, private equity groups, that sort of thing, commercial banks, and we're just not equipped to raise highly speculative capital.
About how many people do you have to go out to in your network before you can kind of find the right partners for each piece of the cap stack?
Good question. Recent deals we went out to for a senior ABL asset-based line. We went out to, I think, about 15 senior banks, which was great, very competitive. We got a great deal for our client. And we've gone out to as many as 300 for, full deals.
Goodness.
Cap stack. When you add everyone up, all the different layers, it's as many as 300.
That's
different
wild.
groups.
You've got to have quite the spreadsheets.
We do have quite the spreadsheet.
It's a lot to keep track of.
Yeah. Well, you send out the teaser and the, non-disclosure agreement, and you follow up with a high probability folks that should be interested. And then send out SIMs, and then you follow up, and follow up.
Right. It seems almost similar to the sell-side process.
It is very similar. The difference, of course, is you're dealing with the puzzle pieces, whereas in sell side you're just trying to find a buyer and they have to worry about how to finance it.
Right.
Yeah, it's still 500 to 800 hours worth of work probably per deal.
So what kind of advice do you give to companies when you're talking to them about balancing out their debt versus equity and thinking through that with a cap stack?
They have to be comfortable with debt. Sometimes we have clients that are very debt adverse, sometimes because they've had a bad experience. I tend to be more comfortable with debt. I lived through the junk bond years as a CFO, and we had 10 times leverage, and nobody thought much about it. Probably a mistake, but when you're there are some pretty well-known metrics that you have to follow. So when you're looking at debt, you want to make sure they can service it. So you've got a debt service coverage ratio. Now, the commercial banks look at leverage as the amount of debt divided by EBITDA. And the commercial banks don't want to go more than 3 times, and they usually want a cushion in there. Because if they go more than 3 times, it is classified as a highly leveraged transaction, HLT. And it increases their insurance costs, their capital costs, etc. So you have to understand that. And then you've got fixed charge coverage ratios. So that's interest plus principal payments. And you want to make sure that the company can manage those. Now, within that, of course, you might have senior debt, and then you might have subordinated debt. Well, maybe you can make the subordinated debt interest only for a period of time. This is when I was talking earlier about an infinite variety of flavors of debt out there. That's how you can play around with these ratios and make it work for a company. Now, you don't want to go crazy there, obviously, but a lot of it depends on the appetite of the client. Likewise, equity. You can do common equity, which would be dilutive to them. Maybe you can do preferred equity and make it look a lot more like debt, act more like debt. But from a banking standpoint and from people looking at their credit worthiness, it's going to appear as equity. So again, you get back to that puzzle. We start every transaction with a blank slate. And it's after we build the model and really understand the business that we can start honing in on what the balance sheet will look like for today and down the road.
How often when you are talking through it with them and you're looking at their financials and you're looking at their operations and what they want to go do you have to tell them, you think this is going to cost X, but it's actually going to cost twice that much, to be successful? How often do you have to kind of rejigger their thinking in terms of how much they need to achieve their goals?
Surprisingly, not that often.
Okay.
They usually have a pretty good idea of how much money they need. Sometimes, obviously, it's wrong. But in our experience, normally we start out with a number, and sometimes they want to increase it, but it's not too far off normally.
What are the common missteps that you do see when working with someone?
First misstep is they try to do it themselves. We have had several instances where we talked to a company and they said, oh, gee, that's going to cost money because we don't work for free. And they
You shock me.
Yeah, sorry. And they go off and they try to do it themselves, and they come back 5 or 6 months later and engage us. That's happened to several times.
Oh, yeah.
There's a couple of reasons for that. First, it is complicated, and building a model, a really, really good financial model, a detailed financial model, is hard. And they don't have the horsepower internally to do that. Second, many entrepreneurs are good at promoting their product or service, not as much good at promoting their company, which is what we're doing. We're selling their company, the concept of their company. And then they don't know the market. They don't know the capital providers like we do. And then lastly, and I guess most obviously, is if we're spending 500 to 800 hours on helping them do this, they probably don't have people of the caliber that we are, who can spare 500 to 800 hours over the course of 6 to 8 months to get it done.
So what kind of things do capital providers look at when they're looking at the company? You were talking just a little bit ago about how to sell your company.
Right.
What do they look at? I know, on the sell side, they look at things like culture. Is that something like a capital provider cares about at all? Or are they just caring about what is the business plan? What are the operations? What's the expected returns?
Depends on whether we're talking equity or debt.
Fair.
An equity provider is going to look at it very similar to sell side. They're looking at all the things you mentioned. Mm-hmm. And what's the return going to be? What's my return on invested capital or my IRR, those sorts of things. Debt is looking more for consistency. Debt providers don't necessarily care if the company's going to grow, don't necessarily want the company to take risk. If the debt works at today's numbers, that's fine. And that's what they're looking for, really, is consistency of earnings.
Right. The revenue. Yeah. Okay. That makes sense. How often say that when you're building your capital stack, you have one capital provider. If you go on, do you come to them and say, this is the cap stack we're looking for, so they know just how leveraged the company is going to be? Or do you just speak to them individually? Like, how much do they need to know what the other players are in the capital stack?
That is a challenge because we're going out to the market simultaneously.
Right.
And sometimes we go out with a proposed capital stack, but we make it very clear that we're open to other options, which is how we end up with the 30-year cash flow loan.
Yeah.
And you have to, because we don't know what everyone's requirements are, what their goals are. For example, SBICs, small business investment companies. Some have a goal of 25% equity, 75% debt in each transaction or overall. Some do only debt. There's a few that can do control equity.
Really?
Very small number that can do, they've got permission to do control equity.
Huh.
So when you're going out to 300 people, everybody's got their own kind of preference, if you will, on what the cap stack should look like from their point of view. So you have to be flexible, and yet you're still trying to get the best deal for your client.
That makes sense. It does. What other things are those kinds of things that your clients don't know that they don't know until they come to you?
I think the biggest thing is they don't understand the variety of capital available. They think of bank debt and they think of equity. And they just don't understand all the different permutations that there are out there and how they can benefit from them. Mm-hmm. That's probably the biggest.
Okay. And how often do you have to look at a capital provider and say they are a good partner or they're not a good partner? Do you get a sense of that from working with them over time as well?
Absolutely. And we do due diligence on these folks if we haven't worked with them before, trying to make sure that they've got a good reputation if things go bad. I mean, everybody's great when things are going well, right?
Right.
It's when things go sideways that you really have to understand who you're working with.
Interesting. What are the red flags that you look for?
In a capital provider?
Yeah.
Going back on their proposal, retrading a deal, or being difficult to work with, both in terms of documentation, in terms of working with the other members of the cap stack, and then clearly if they're not good to work with if there's a problem after the deal is done. That's clearly a red flag.
Is that typically just kind of industry lore that you hear out there, or are there ways to really research that?
You research it by talking to people.
So you have to have some pretty deep industry relationship pockets.
Absolutely. Yeah. And, I mean, put a plug in, AMAA and the conferences. It's a great way. I mean, seriously, when we go to the conferences, we focus on meeting capital providers and those people, equity providers who willing to provide minority capital, because that's what we often look for when we're doing a cap raise.
Right.
And getting to know those people over time, building a relationship, it really, really pays dividends.
And how do you, when you come, like we've been talking about the red flags that you see in them, how do you put yourself forward as someone who is someone they want to work with?
I think we talk about our experience and
tell stories.
Tell stories, and we have a lot of good success stories to talk about, a lot of happy clients who are reaching their goals and have reached their goals. And I think that's what does it. You just stick around long enough and work hard enough and be successful, and then people will come to you. And they'll send you new opportunities because they've worked with you in the past. And they'll feel comfortable having their clients work with you.
Mm-hmm. How often do you have a repeat client that, you know, they've achieved what they wanted, you keep in touch, you check and make sure they're doing well, and then they want to do it again?
Yes. We've had a couple, not many, just because 10 years isn't that long a time.
Fair enough.
Where we raised capital for a gentleman who had a company. He did a large acquisition. We raised capital. Company did well. They sold it, and now he's looking to buy another company, and we're working with him now. So
nice.
That's the kind of thing that makes you feel good.
It's true. It does
Right.
make you feel good. How do you keep in touch with them? Other than Christmas cards, obviously.
Just call them every once in a while.
Say, how's it going?
Yeah, number of clients have become good friends.
Mm-hmm.
We've vacationed with them,
Oh, that's fun.
and just stay in touch and see how they're doing.
And learn from there. I love it. All right, what else? What do you do in your spare time? Do you have spare time?
I do.
What
I
do
do
you
have
do in
spare
it?
time. Well, I love to read, love to travel. I referee high school boys lacrosse.
Oh, lacrosse.
Yes.
That's very fun.
Which keeps me active, I guess.
It would.
But those are the main things I do.
Best book you've read this year?
Oh, I read Snowflake, the biography of Warren Buffett. That was very interesting.
Oh.
And I'm currently reading 1929 by Andrew Ross Sorkin about the crash. It's amazing the stuff they got away with back then, and it was legal.
Absolutely.
The things they could do that are now illegal. It just, the stock market was totally rigged.
Wild West.
Absolutely totally rigged. Great book.
Oh, that's good to know. Do you read mostly history, that kind of thing?
I intersperse fiction in there, and I like thrillers and that sort of thing.
Oh.
Yeah.
Well, that's fun. And travel.
Travel.
Where's your favorite place to travel?
Well, go to Hawaii a lot,
Fair.
right? And I love France.
Oh, okay. What parts of France do you like? The city? Do you like the
Well,
country?
we love Paris. We've
Okay.
been to Paris quite a bit. Most recently, we did a big circle around Paris. So we did Champagne and then Normandy, and then came south and east through the Loire Valley.
What's your favorite time of year to go?
Ooh, good question. Spring or autumn, probably.
Okay. That's my favorite time to go to Italy.
Yeah.
Fewer people.
Fewer people, good weather normally.
All right. Well, thank you so much. Anything else you want to share? Anything else you want to discuss before we say farewell?
I think that's it. You did a great job. Thanks.
Thank you so much for joining us. We hope that you learned some great tidbits for your 2026. If you need some capital providing, go see Robert. And we will see you next episode next week.